And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Thursday as we get ready to wrap up this week. And wow, what a week it's been already, right? It's the whole Omicron, as President Biden says. Pick your name, pick how you like to pronounce it. It's a variant. Well, it showed up yesterday in California, and of course, this elicited more concerns to the markets. Markets sold off yesterday. So we're going to talk about that a bit this morning. Also, kind of how to position now. We've been talking about for the last couple of weeks heading up to Thanksgiving. We were talking about taking some profits, raising some cash, kind of rebalancing risk, reducing risk, because there were some technical indicators that were talking about the weakness in the markets, and we had posted these a few times. And then also we talked about seasonality, that in the first 2 weeks of December, there's typically weakness in the markets as mutual funds go through distributions and those type of things. And again, when you already had a very weak market, and we talked about some of the internal breadth was very weak, the number of stocks above their 50-day moving average have been declining even though the market was going up. Same thing for the stocks above their 200-day moving average. Well, that internal weakness and has provided that fuel, right? It just needed a catalyst, right? We needed a reason to justify the selling, so to speak. And again, the selling was going to occur regardless because, again, as mutual funds have to make distributions, that's going to cause some pressure on markets. And that typically happens in the first couple of weeks of every year. If you look back over, average performance for the month of December, going back to the 1950s. So, it was there. So, but what we need as humans, we talked a little bit about this yesterday, is that we need to assign a reason for things, right? We have to have a reason for something to happen. And so that reason has popped out to be the Omicron virus. And again, if you listen and read what the doctor in South Africa wrote when she first discovered this variant in South Africa, she says there's nothing to really be worried about here. It's no reason to panic. And, they were discussing some of our comments yesterday at length. And, of course, the markets kind of knee-jerk react to every variant that comes along. But again, this is just the headline, right? This is the reason that we assign to the sell-off. It really has nothing to do with the sell-off. And what I mean by that is nobody was sitting around over the last couple of days going, oh my gosh, the Omicron variant is going to be we were selling off already. The markets are already declining before the variant even showed up. So the whole world knew that the variant was going to show up 3 days before it actually showed up. I mean, it's pretty neat, right? So this is just, the point here is to not extrapolate headlines into reasoning and those type of things. Right. It's just that markets go through these cycles. We were very overbought. We were very extended. We were going to have a correction regardless. And if the market had corrected because Apple announced a week ago that they were going to have weak iPhone sales, well, then we'd be attributing all to, Apple and the iPhone sales. Right. I mean, it's just the markets need that reason. As human beings, we have to assign a reason for something to happen. But that's not always the case. And again, we've been talking about the potential weakness here in the markets for the last 2 weeks in our newsletter. So, again, we had positioned for this by raising some cash, adding some hedges, and doing some things in our portfolios to prepare for it. So here it is. So now what? Well, first of all, I wanted to direct your attention to this chart. If you're watching our live stream, I have a chart of the S&P. Don't worry if you're driving to work. Don't pull up your phone and try to watch, right? I'm going to explain it to you. And we'll get you through this. It's all good. But I do have, if you are watching our live stream, I do have a chart up of the S&P 500. There's some critical things that are going on that are worth paying attention to. First, if we go back to October of last year, and we kind of draw a line across the market's been this very nice kind of, 45-degree angle ascent really since October of last year. And by the way, if you don't remember that far back, because we're all getting older, take your ginkgo biloba. Exactly. Back in September and October of last year, we had 5% corrections back to back. And the markets got very oversold, very negative. And then from that kind of low point in October of last year, we've had this 45-degree angle rally in the markets. And the corrections that we had along the way, and we've talked about this numerous times, is that every time the market corrected, we either corrected back to the 20 or the 50-day moving average, but there's a very defined angle of ascent. And if you take a line and you kind of just draw a straight line across the tops and the straight line kind of across these bottoms where we were touching along the 50-day moving average, you'll see this kind of very defined angle of ascent that's been narrowing, right? The range of price movement has been getting more and more confined. So think about compressing a spring, right? You kind of keep pushing the spring, getting it closer and closer and closer. And then if you let it go, it springs back, very quickly, right? It has a lot of force to it when that uncoiling occurs. And that's kind of what's happened here, is that we broke through the bottom of that accelerating trend line. And as soon as we did that, the market, that kind of triggered all the algorithms, et cetera. And then that's kind of where all the selling really started to occur. And we've had this kind of very sharp decline over the last few days in particular, back down here to the 50-day moving average yesterday. So yesterday we are sitting right at the 50, actually just slightly below it, but it won't matter. But we're kind of sitting on the 50-day moving average right now. And so that's probably going to provide some support. This morning, the markets are looking to open up about 250, 260 points. Now, that's not going to be enough to recoup yesterday's losses. Now, that's the important thing, right? We'll be up a little bit this morning. The question, we were up yesterday morning too, about 300 points yesterday morning, and then wind up giving it all up because of the Omicron variant discovery in California. So, we weren't done with the selling yet, is all that means, right? We just had more selling to go, and as soon as that news kind of showed up, more algorithms kicked in to sell stuff, but the selling was already going on anyway. So we'll see. We'll have a bit of an open this morning. It's a little bit higher, but I suspect that, we could finish the day on the upswing today. That would be decent, and we need to kind of hold this 50-day support level. And that's going to be really important here. If the markets failed to hold that support, now just below that, we've got the 100-day moving average, which has been really good support ever since those October lows. That was the low in October. That was the low in November. That was the low back in kind of mid-March when we had the tech rout back in mid-March. That was where ARK sprung a leak. That was also the support line in the recent sell-off in September, October of this year, right? So, we've got some good support here in the markets, and we're getting very oversold, very negative sentiment. The number of bears that are bearish right now have risen sharply. The CNN fear greed gauge is very low here. So, we're probably getting set up for that end of the year kind of Santa Claus rebalancing, positioning rally. And so one thing we want to talk about today is, looking for some areas of opportunity to start adding some money back into your portfolio, where to be looking for those opportunities. Also, though, I'm going to talk with Michael Leibowitz today. There's a lot of similarities between where we are in the market today in 1999. And Michael just wrote a report yesterday that's on our website, realinvestmentadvice.com, talking about using valuations as a measure of this. And not just from a function of saying, oh, market's overvalued, but are they overvalued relative really to where we were in 1999? And what does that portend to the future of returns for investors? All that's coming up in today's show of The Real Investment Show. I'm your host, Lance Roberts. We'll be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual lunch and learn on long-term care. December 9th at noon. RealInvestmentAdvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, welcome back to the show this morning. I'm Real Lance Roberts, taking your questions in the comments here. I've lost Michael here, who was here a second ago, and he went away, so I'm not sure what happened to his feed. But that's okay. We've got some stuff to get into this morning. So, interestingly enough, as we were talking about here before the break, is that, now's the time to start trying to reposition portfolios potentially, after we've had this big run up here, previously, and the markets got very overbought. And again, just a bit of a recap here in the newsletter over the last few weeks. We talked about, raising some cash, reducing risk, adding some hedges, doing those type of things, just kind of the normal risk management. And this is really kind of the key thing, right? And we wrote about this several times, in the newsletter as well, which, all those are posted, by the way. If you don't believe what I'm saying, you can always go to the website and check it out. Go to realinvestmentadvice.com, click on the newsletter link. On the right-hand side is the archives, and you can go back. We keep all of our newsletters posted for you, so you go back and double-check us, right? Is what we said right, wrong? Sometimes we're right, sometimes we're wrong, and, we try to be as accurate as we can, but, sometimes we miss the ball. It's okay. But that's the whole point about risk management, right? So, we're investing capital, and we're trying to make sure that we maximize the return on that capital, and we can't always be right because we're guessing, right? This is the funny thing about the financial markets, and we've talked about this before, is that investors are, so let me rephrase that, right? Individuals, they say, "Oh, I'm investing in the stock market." No, you're not. I'm an investor, right? No, you're not. I'm a long-term investor. No, I'm not. And let me give you a good example of this. Got an email yesterday. So, guy emails me, and I get these a lot, right? This just happens to be a recent example. I get an email yesterday, and the gentleman says, "Hey, I bought this company for the yield. It's a long-term yield play, but I bought this company for a long-term hold because it had a 16% yield. It's been going down in price ever since, and I'm not sure what to do with it now." Well, here's the first thing, few things right up front, right? If the yield on the 10-year Treasury is 1.75% or less, right? Right now we're about 1.5% on the 10-year Treasury, and something's paying you a 16% yield. What's wrong with that picture? You don't get paid 16% for no risk. And remember, when he bought the stock, he says, "I'm buying this for a long-term hold, right? I'm not ever going to sell this. I'm just going to collect 16% on it from here to the day I die," right? That's awesome. Problem is that you don't get yield. What you get is the cash dividend. And in this case, it paid 75 cents a share. Now, if it's paying 75 cents, has a 16% yield, it tells you this is a very low price stock, right? It's trading about $5. So immediate red flags, right, pop up everywhere. When something's paying you a yield that is way above what the 10-year Treasury is giving you, there's a reason for that, because there's risk. There's financial risk to the investment. So that's the first red flag. Second red flag is stocks trading about $5. Okay, that's another problem. Very low price stocks are low price generally for a reason. The other problem, of course, is that whenever you make an investment, and this goes back to what I was just talking about, being an investor or a speculator, you're not an investor in the financial markets. You are a speculator. You are simply buying something in the hopes that it's going to grow for you in the future at some point. And if you're hoping for something, if you're betting on something, right? I'm betting on higher prices in the future. That's why I'm buying something today. I'm going to bet on a higher price in the future. If that happens, that's great. But it's a bet, right? And as soon as you take the word bet and throw it in the middle of the sentence of putting money to work in the capital markets, you're a speculator, because that's what you do at a poker table. And your odds are about the same. And in this case, a good example, he was making a bet on a company that it would continue to pay 16% on this particular investment, right? And again, you don't get yield. What you get is the dividend. So he was betting that the company would continue to pay him 75 cents a year on the shares that he owns. He could buy ExxonMobil and get $3 and change in annual dividends. Much stronger company. But people get attracted by that big yield, right? Oh, I'm going to get 16%. That's not the way you invest. But it's a bet. He was betting on this to happen. Well, the stock lost 50% of its value. So the point is that, yeah, great, I'm getting a 16% yield. Now I've lost 50% of my money. And what happens to most companies is when they're paying a very high yield and the stock goes down a whole bunch and the company's in financial trouble, what's the company what is the first thing the company does? Cuts its dividend. So now you've lost 50% of your money and you lost your dividend. So what was the point now? So the point is that we're all speculators. We are not investors. Warren Buffett's an investor. If you invest in a private company and you can go in and determine the direction and course of that company and determine its sales and its marketing, that's being an investor, right? You're in that long term. You're going to grow that business. You're a small business owner. You are an investor in that business because you are invested in that business to make sure it grows. But in the financial markets, you're always a speculator. You are never more than a speculator unless you can start acquiring 10 and 20% of a company and control its outcome. So always keep that in the back of your mind when you're investing in anything in the markets. The first thing that you invest in, when you invest that first leg of capital in any stock, the first thing you should know is exactly where you're going to sell it if things go wrong. How do I get out of it if things go wrong? And how much money am I willing to lose if this bet goes wrong? Then let's go back to a poker table real quick. I've got a really poor hand, but I'm going to bet on it anyway because I think everybody else has a worse hand, but I'm not going to bet a lot, right? I control my bet. Same thing with investing. When you're investing on a stock and it's exceedingly overbought, overvalued, extended, not a great company, but you're going to bet on it anyway, control your bet. How much do you put into it? How much risk do you take? How big of a position do you take within your portfolio? And then if you make that bet, where are you getting out of it if it goes wrong? Am I willing to lose 10%, 20%? How much am I willing to lose? And put that stop in there and make sure you honor it. So when you hit that point, you're out. Control risk. That's what we've been talking about over the last couple of weeks. Taking profits, reducing the size of our exposure to equities. Things that had run up a whole lot, we reduce those sizes back down to target weights. In every position in our portfolio, we have a maximum amount of size that position can take up relative to the amount of risk that we're taking in that position. So if it's a highly volatile stock, or if it has, if it's a momentum type investment, we reduce the size that we're willing to allocate to that position. So if our maximum size of any position is 5% of the portfolio, maybe the maximum size of a more volatile, risky investment is 3% of the portfolio. Worst case scenario, something goes horribly wrong. Stock opens up at 0 the next day. We lose 3% of our portfolio, but we don't completely damage the outcome to our investors. So again, it's all about risk mitigation. It's about managing that, because we're speculators. We're simply making bets on the markets. And so, what we talked about over the last couple of weeks was sizing that risk down, because we expected that, we had a very hot hand in October. We were very happy about that. Getting into early November, things were very overbought. And just like when you're in a hot streak at a poker table, you're getting hand after hand is just coming your way and you're winning. Well, that hot streak is going to end. And this is how the house always winds up winning, because people don't know when to leave the table after they have a series of a hot streak. And then it goes cold and they keep betting, trying to get that hot streak back, and they wind up giving back all of their gains. That's the same thing that happens with investors. All the gains that we made in October are now gone for the most part. So now what do? Now you're just trying to get back to even. So by taking profits and locking in some of those gains, now we've got capital to invest. And that's the thing that we want to start talking about is, where do we start looking for opportunity now? Because we knew this correction was coming. Let me rephrase that. We don't know anything. We made a guess that a correction was coming based on a series of things that were going on. The markets were very overbought. We had, internal breadth was deteriorating. As I said earlier, the number of stocks above the 50 and 200-day moving average were going down, et cetera. So those are the problems that we saw coming. And so we could make an educated guess by looking at those technical internals, that technical voodoo we talked about yesterday, that black magic that we talked about yesterday, right? That's that technical bias. And all that is just telling us what the psychology of the market. There was something kind of going on with the markets that we were going, this just doesn't feel right. And so we reduced that. Now a lot of that's been washed out. Things are getting very oversold. Sentiment's getting very negative, and statistically and seasonality-wise, the end of the year tends to be fairly decent. And that should suggest that we should get a bit of a rally here over the next couple of weeks as we head into the end of the year. And that's obviously something we want to try to take advantage of, but do so carefully. So when we come back from the break, I'll see if I can get Michael Leibowitz back on the line. And we'll talk about that and how to position for this. So anyway, get by the website, realinvestmentadvice.com. Again, all of our blogs, our research papers are all there for you. And the reason that we publish stuff every day is to let you know what we're thinking and what we're doing. And that's basically how we do research. These are the things that we're looking at to research what we're doing for our clients and our portfolios and our money here at RIA Advisors. And we publish it. It's all for free. And it's on the website now, realinvestmentadvice.com. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual lunch and learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual lunch and learn on long-term care. December 9th at noon. realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN. RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I went to see the doctor. Really great guy, but he's an older guy, kind of like Coach Murphy that you grew up with in high school. And it never cost me more than $25 to go see him because his solution is pretty much the same every time. Rub some dirt on it and walk it off. And I said, well, don't you have something you maybe give me for the pain? He hands me a thing of Tic Tacs. He says, take one a day and pretend it doesn't hurt. What's your problem?
The Real Investment Show podcast. Same show, your schedule.
And it works just fine.
At realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. So I want to bring on the show right now Michael Liebowitz, CFA, who's the man solely responsible for the baseball strike. Mike, welcome to the show this morning. How are you?
Good. JP, one of our followers on YouTube, Godzilla didn't get the best of me. I'm back.
I know, right? Apparently, I don't know what you did to upset your wife, but apparently you've been sleeping in the basement for far too long. Your beard's really starting to grow out here, so...
You keep telling us we're going to have a Santa Claus rally. I got to get the beard going.
Exactly. Well, as I said, apparently the Major League Baseball players were listening to our show last week when you were talking about how that, employees now have pricing pressure and they can kind of go in and demand, better wages and this type of stuff. And, they showed up in Dallas for their meeting that lasted 7 minutes and they walked out. And now Major League Baseball is now on strike. I guess that's all your fault.
It's all my fault. Now that the Nationals aren't very good, it doesn't really bother me.
That's true. You had your moment of glory, right?
I did. That was fun.
All right, a couple of things here. I was talking a little bit about, the market this morning, of course. We've had this sell-off over the last few days. Of course, the media wants to attribute this to, the Fed and it's Omicron or Omicron, however you want to pronounce it. But we've been talking about a potential correction here in the markets for the last really 2, 3, 4 weeks. Markets were very overbought, extended, and so now we're going through this correction process. And before we start talking a little bit about kind of where to start looking for opportunity, just want to get your thoughts on the sell-off. And here we are sitting back at the 50-day moving average. Is there anything here that's kind of concerning you near term?
there are things that concern me. We talk about them all the time. But you said that earlier in the show, you said it correctly. On last Friday, the market sold off because of Omicron, and that was the excuse. Then we come in Monday, Tuesday, Wednesday, and Omicron is much less of a threat than we thought on Friday. On Friday, we thought we were going all the way back to March 2020. We're locked down and can't breathe, and all this crazy stuff. But now it's Fed Powell is shifting to a more hawkish tone. So again, the market is putting these factors, these excuses, to explain what's going on. Just like we have to, like you said, we have to explain everything in life.
Yeah.
We want to understand what's going on and whether the narrative to explain it is true or not true or partially true. And look, they're partially true.
Sure.
The stock market doesn't want to see even a slight shutdown of certain economies, even if they're outside of the United States, right? Mm-hmm. And Powell shifting is a big deal, right? And we can talk about that, but this has been coming. He's been signaling this. And so that's, if you ask my concern, it's not Omicron, it's Powell shifting to a more hawkish tone, caring more about inflation, a little bit less about employment. Signals that they're going to taper a little bit quicker and potentially get to rate hikes maybe in March instead of June or July.
So, it's interesting, though, and as we talk about this, there are some asset classes that you think would be performing better. Again, the one thing that, we've noted before is that, there are certain asset classes that tend to perform when there's a risk-off bias in the market. One of those is bonds and on the long end of the curve, right? So the 10-year, the 20-year, the 30-year bond, those yields have been coming down fairly sharply here over the last couple of weeks, as you would expect, right? You have that risk-off rotation, money coming out of risk, going into safety. So bonds have been performing better because of that. But another area is that, we get a lot of questions about, and we've avoided this one sector to a large degree. We've dabbled in it a couple of times over the last couple of years on intermittent rallies, but we haven't hung around very long because it just simply really hasn't been performing. It has been gold, and you would think that with this kind of this risk off rotation in the markets that gold would be performing better. But, it had a little run up to around, 1850 or so, and has now given all that back up. It's back down to 1775 yesterday on the spot price. So, what's going on with gold that, it's not, kind of been really performing here and has not been, has really underperformed the financial markets over the last year in particular?
Right. It hasn't been the place to go for inflation fears.
Right.
But what it has done is it's followed exactly what we would have thought it would have done based on what's going on with interest rates and inflation expectations. So there's a factor out there called real rates. And what real rates are interest rates less the rate of expected inflation. And that really tells you how much the Fed is affecting markets. So right now, real rates are negative 1% or more for 10 years. So if you buy a 10-year Treasury note and you get a yield of, let's just say, 150, and expectations for inflation are minus 250, you're actually going to lose 1% a year of purchasing power.
Right.
So that's what real rates tell you. And there's a very strong correlation between real rates. The more negative real rates get, the higher gold goes, and vice versa. So when we've had these wild swings in both inflation expectations and Treasury yields, and what we're finding is that gold is reacting in line with those changes. It's just not what everyone's expecting. Now, we have a Fed now that's becoming a little more hawkish. It's Powell, it's Clarida, it's the Vice Chair Clarida, and it's many other members of the board. So what they're saying is that we're going to be doing a little bit less QE. We're going to taper. We may raise rates. That should push real rates higher, which is a negative for gold. So, you can watch all the inflation narratives, all these things that the gold bugs tend to follow. But at the end of the day, for the last 5 years, it's been real rates that have driven the price of gold.
Right, and real rates are at some very low levels. I mean, we haven't seen real rates this low in like 20 years or something. There was a chart out recently, and I mean, it's been a very long time we've seen real rates at this level, right?
I think the 70s, 80s was the last time.
So,
we saw that's
like
because
20
yields
years
didn't go up
plus
as
a little
much
bit.
as inflation. Right.
But but again, this is one of those problems here. We have rising inflation. People have been buying gold in an expectation that it was going to hedge them against inflation. And we wrote an article about this recently on the website saying that there are times in history where gold has been a very good inflation hedge, and there's also times where it hasn't been. And this is one of those times where gold has been a very poor hedge for inflation. But if we're looking for opportunity, and again, this is, I think, the important thing about portfolio management, and we talk about, managing risk, and, that's what we talked about in the last segment, is, markets have now gotten fairly oversold. Markets were looking to open up this morning. That initial kind of opening is now starting to weaken here a bit. We're still going to open on the positive side, but a lot weaker than what futures were initially predicting. We're probably not through this entire mutual fund distribution process just yet. There's probably some more selling to go here over the next few days. So, a little bit more sloppiness in the market, a little bit more volatility, certainly not surprising. But, one area of the market that's starting to look really interesting here from an oversold condition has been energy. And, we'd recently had reduced exposure to energy stocks here. You and I have been talking the last couple of days about looking for some opportunity there. What are your thoughts?
They've actually, a lot of the energy stocks have hung in really well, too. Right? They haven't been getting, the price of oil has just been getting clobbered, right? It's been down 3, 4, 5, 6, 7% some of these days. And the oil stocks are not falling nearly as much. If you look at graphs, they're kind of holding their own. They're off from their highs, but they're not off nearly as much as the price of oil. So that's a positive sign. But we need, and there's a lot of political pressure on oil right now.
Right.
And other things going on, such as OPEC, right? Well, OPEC cut production because all these countries are releasing oil reserves. You got the demand side, the supply side. How will a stronger dollar affect the price of oil? So there's a lot of balls in the air. But it's encouraging that the prices of the oil stocks have hung in really well. And I agree with you, Lance. I think that if oil can stabilize, at a minimum, the oil price, the stocks of oil companies will probably outperform the market here going forward.
Well, and one thing too that's interesting is there's been a lot of pressure on Biden and the administration in general to get oil prices down because that's leading to inflationary pressures, and everybody's upset about the price of gas at the pump. And what'll be interesting to see is that this decline in oil prices probably won't reflect much to gas at the pump. And this is the mistake that the Biden administration was making by telling the DOJ to investigate oil companies for price gouging. These prices are set by NYMEX, by speculators and hedgers, on the New York Mercantile Exchange. And the sell-off recently is not unexpected. We wrote an article on this on October the 15th, talking about how hedgers were way too long oil. There was going to be a correction. Well, now here it is. And now I think we're at a good position investment-wise to take advantage of some discounts and prices. Another area that's kind of been beat up here lately, technology's taken some pretty rough shots over the last few days. I think a lot of that is really going down to mutual fund distributions. A lot of mutual funds had a lot of gains in technology stocks, that they were also overweight technology in terms of portfolio allocations, and from their investment policy standpoint, they've got to rebalance portfolios and take those gains and distribute those for the year. So I think a lot of the selling in tech is coming from that. But, technology's been the strong player of the year. And, do you think that there's, some opportunity maybe in some of these tech stocks that have really gotten beaten up?
Yes, and especially the smaller ones, not the Microsofts, Apples. I mean, Apple was up, 2-3% the other day when the market was down a couple percent, 1.5%, whatever it was. So I think you have to look beyond the big names and kind of the recent high flyers, the NVIDIAs, the chip companies in general, and look below the surface at some of these companies that were up significantly earlier in the year, given up a lot of gains, but have great technologies that people are using. Yeah. And those are the companies that have the potential, that have been sold off pretty drastically. And, assuming the market can get its feet again, they have a lot of upside potential here.
We'll come back with Michael Leibowitz. We'll talk a little bit about ARK springing a leak as well, specifically to tech stocks and more. Coming up right after the break with Michael Leibowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual lunch and learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual lunch and learn on long-term care, December 9th at noon. realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm Real Lance Roberts. Michael Leibowitz joining me this morning, talk a little bit about markets, money, investments, and the sell-off. And again, I don't think we're done with the sell-off just yet. What will be critically important over the next 2 days is to making sure that we hold support here between the 50 and the 100-day moving average. They're basically sitting on top of each other. So there's a lot of support for the markets at these levels, but doesn't mean the selling is over yet. Now, if we break that 100-day moving average, it's an entirely different story. And we'll be talking about something much deeper at that point if that occurs. So I don't expect that to happen. Markets are getting fairly oversold, fairly fearful. We'll probably get a bit of a rally here. So, we'll want to use that opportunistically as we go into the end of the year. But one thing I wanted to touch on, though, is that, early this year, and I should go into last year, ARK was the rage. ARK is and if you don't know who ARK is, that's Cathie Wood. And she was being held as one of the most innovative portfolio managers, ever in history. In fact, her ARK fund, ARKK is the ETF, was just accumulating assets at a record pace, and it actually achieved the record for accumulating assets at the fastest pace on record. It was just everybody was piling into ARK. And of course, then March of 2021 came along, not 2020, but March of 2021, this year, where there was a decent tech rout. And we saw companies that she was mostly investing in, companies like Tesla and Square and blockchain companies, et cetera, all getting, fairly beaten up around the head and shoulders. And her fund began to underperform rather markedly. Well, the problem now is that her fund is negative in terms of returns for this year. She's now experiencing a lot of money outflows. People are giving up kind of on the I don't know how the praise of Cathie Wood. She was being hailed as almost a demigod in the investing world. And now all of a sudden she's kind of being, thrown out, but kind of baby with the bathwater. But I wanted to kind of just touch on this very quickly because I do want to get to your article about, future returns and valuations. But I think this has a lot to do with that, is that in every speculative kind of investment bubble, we see these type of things where people just, pile in to something in particular and then it ceases to work. And we're seeing a lot of that kind of same psychology here, and I think kind of ARC is a good representation of that, because that was the one thing everybody had to be in, and now it's a thing of the past, so to speak. And it'll be interesting to see how she if and when she can potentially turn her performance around, considering where we are valuation wise in a lot of the companies that she owns.
Right. She was in those tech companies that were soaring at the beginning of the year. She was momentum. So if you wanted to play momentum technology, you could just buy her fund, her ETF. It was a great way to do it. And it went even beyond buying her fund. Everyone's looking at what she owned, how much she was buying, what she was selling. And it was almost like what we see on Reddit and Wall Street Bets and all that stuff. Whatever Kathy did, everyone else did. So it just made her bets look better and better. And she had a great beginning to the year. But as we've talked about over and over again, this market is just shifting from one idea to another very quickly. And Kathy's idea is technology. It's new blossoming technology. And she really didn't sway from that, as she shouldn't, because that's what her fund is supposed to do. But when other things came into vogue, when financials and energy, old school Dow Jones type industries came into vogue, she was out of vogue. And what happens is, let's say Kathy's fund is $1 billion and I have $100 million invested in her fund and I sell it. Her fund is now $900 million. Kathy has to sell $100 million of stocks. She can say, okay, I'm just going to sell Tesla, or she can sell 10% of everything. And it's somewhere in between what she does. And that's part of the problem. And that's what's dragging down both some bad stocks and some very good stocks that we've been looking at.
Yeah, no, and that's a great point, is that, there's been a lot of headlines lately about her selling her Tesla shares. And of course, she's a major advocate of Tesla. But it's not because she wants to sell Tesla. It's not because she's choosing to sell Tesla because of fundamentals or whatever. She's having to sell Tesla because it's one of the largest holdings in her fund. And so when somebody makes a $100 million redemption, and there's been a lot of $100 million redemptions in her funds over the last several months, she's having to sell stocks to meet those redemptions. And that's putting pressure on her fund and particularly on those underlying shares of the smaller companies that she's liquidating. Companies like Square and others have been under a lot of pressure really since August of this year.
Right. And if you want a place to go look for some good ideas, go look at her holdings, because there are some really good stocks and good ideas in there that have gotten clobbered. And it's getting clobbered in part because of what's going on with Kathy Wood and the ARC Fund and her followers. So that's a good place to go fishing if you're looking for some names that have potential that are down 30, 40, 50% from prior highs.
But I want to switch gears here, because you just said something that's important, and this relates to the market entirely. When you're going to fish for, opportunity, it's important to make sure that you're also buying fundamentals as well. So you got to look for companies that have been beaten up in price but have a strong fundamental case. Maybe they don't have a strong fundamental balance sheet at the moment because they're a rising kind of technology company, et cetera. But you need to be looking for increasing sales, increasing earnings, those type of things that are going to be driving that stock in the future. It's important to consider that. But when you look at the market as a whole, and you just wrote a report on this yesterday, it's on our website now, realinvestmentadvice.com, asking the question, when you look at valuations today, it's very much like we were back in 1999. And, this has some consequences, but you kind of approach this from a different angle, saying, because even though valuations are the same as they were basically in 1999, are they really the same? Could you explain that a little bit better?
Yeah, and what I want to preface this discussion with is, this is why we talk about the Fed so much. So now we're going to go back to stocks, but by the time we're done, I think you're going to understand why we have to think about the Fed, watch the Fed, listen to the Fed. So, if you go back and look at 1999 to today, valuations in almost all cases today are higher than they were back then. So basically what you're saying is investors are paying more than they were in 1999. Forget prices, just valuations, ratios like price to earnings, price to sales. There's a handful of them, right? But that's not a fair statement on its own to say that we're more expensive than 99. What if I tell you that earnings are going to grow 20% for the next 20 years and the economy is going to boom and we're going to be in a utopian economy? Well, then stocks are probably very cheap right now. I don't care if they're at the same valuations as 99. The cash flows underneath all these companies is going to grow rapidly, right? So So that's something to consider. However, when you go back and compare the economy, earnings growth, productivity growth, demographics, it's all worse. So all the tailwinds to growth are worse today than they were back then. Now you add on a ton of debt. There wasn't that much debt in 99. In fact, the government ran a surplus, I believe, in 99 or 2000. Now we're running a $1 trillion deficit. Would be awesome if we could get it down to $1 trillion.
It's only 2.8, so I mean, who cares? It's just
right, I don't
numbers.
think we're ever going to see that again, right?
Yeah.
So the amount of debt, not the amount, but the amount of debt as a percentage of the economy is much higher than it was. So that's a burden on the economy, right? So you're paying not only, let's just say we're paying the same in valuations as 99, we're actually paying more because the economic outlook is weaker. And economic outlook translates to earnings. That's what you're buying. When you're buying Apple, you're buying a stream of future earnings. Tesla, name the company, that's ultimately what you're buying. So the question is, well, why would anyone pay valuations today that are on par with 1999, which turns out was grossly above where they should have been? The answer is the Federal Reserve. The Federal Reserve is supplying massive amounts of liquidity to this market. So do valuations make sense? I think you can make an argument they make sense if you think the Federal Reserve can continue to do what they've been doing for the last 10 years. And that's why the Federal Reserve is so important. And Chairman Powell all of a sudden became a little bit more hawkish on inflation, telling us that he may speed up tapering, that they may bring interest rates forward a little bit, maybe to March instead of June, maybe do 3 or 4 instead of 2 or 3 rate hikes next year, right? So all those do is take liquidity out of them. They're still pumping in liquidity, but they're pumping in less liquidity as they do less QE. And given that valuations don't make any sense, even if we were in 1999's economic scenario, and they make less sense today, they make sense in the eyes of when you encompass everything, including the Fed. So that's why we follow the Fed closely, because it's liquidity that is keeping valuations where they are. And let me ask you a question, because we are talking about valuations where they are, which are elevated, obviously, but that has, large implications about future returns, right? Right. So there's a very strong statistical correlation between where valuations are and what the returns for the future will be. The problem is those statistical correlations become very relevant, significant, the further out in time you move. So there's very low, if any, significant correlation between the returns for the next 3 months versus the valuation today. Like we always say, valuations are awful meaningful, but you can't use them to trade. Mm-hmm. They're really difficult to trade on, right? But you go out 20 years and what's called the R squared, which measures how well valuations measure up against future returns, is almost 80%. Right. It's 0.8, 0.79, I believe. So what that allows you to do is say, okay, returns over the next 20 years are going to be poor. But we can also use math, get a little creative and say, well, we know returns over the last 18 years were X, and we know what returns for the 20 years ending in 23 should have been. We can back into what returns for the next 2 years could be.
There you go. And I appreciate that very much, Mike. And, of course, that article on the website now, realinvestmentadvice.com, realinvestmentadvice.com. That wraps up the show for the day. Thank you for joining us. We'll be back tomorrow with Financial Fitness Friday. Be sure to go by the website again and get ready for upcoming events, as well as go to those blogs and newsletters, and also check out our new SimpleVisor.com. That's coming out here over the next couple of weeks as well to help you manage your money better. All at the website, believe it or not, realinvestmentadvice.com. See you tomorrow.